Welcome to Wall Street Training's module on the overview of the financial markets. In this module, we will quickly go through the specific industry jargon and go through exactly what is the sell side, the buy side, what is exactly investment banking, asset management, sales and trading, as well as hedge funds and alternatives. Let's take a look at alternatives. Alternatives is anything that is not long-only publicly traded bonds, stocks and bonds. Alternatives simply means alternatives to your traditional asset classes. Again, alternatives to your traditional asset classes. So if your traditional asset classes are your stocks and bonds, anything outside of that could be considered alternatives. Let's look at the different types of alternatives. Mainstream would be private equity, real estate, and hedge funds. There are also natural resources, timber, pipelines, oil and gas, master limited partnerships, commodities, and other natural resources, perhaps soy diesel or soybeans or whatnot. All of these natural resources alternatives fall into that category. Then you also have financial derivatives, also considered in the alternative sector. Currencies, interest rates, other structured products and derivatives would also be considered alternatives. Again, anything that is alternative to the main traditional asset classes. Let's take a look at the evolution of alternatives. They're actually not new. And in fact, the definition of what is an alternative asset class constantly changes. Take a look at the timeline. In the 1950s or so, the traditional asset class to invest in was actually fixed income. Then, the alternatives were actually considered equities. That's something that we can't comprehend quite at this moment in the 2000s and beyond. However, yes, at some point, equities were considered alternative, high risk. Then, in the 60s and 70s, as equities became more mainstream, they moved into the same box as fixed income, traditional asset class. Then in the 1960s and 70s, same time period, real estate and international investments started becoming popular. And here you can see at the bottom here, the major indexes or indices that were started. The Morgan Stanley Capitalization Index, EFA, East Asia, Far East, as well as NAREIT and NCREIF. That was all the real estate indices that were started as that became more popular and mainstream. Now, in the 1980s, real estate and international moved up into the traditional asset class. And emerging markets and mutual funds actually became popular at that point there. That's right, mutual funds were only around since the 1980s. In 1984, that's when Morningstar, the traditionally considered the source of mutual fund data, that's when Morningstar was actually founded. So mutual funds actually do not have that rich of a history. In the 1990s, emerging markets and mutual funds, everybody knows about them, everybody wants to invest in those. Those became more traditional. Now, what was new and hot and popular? ETFs, exchange-traded funds. Think of them as mutual funds and stock hybrids. And then, of course, you have your traditional mainstream alternatives, private equity, hedge funds, and structured products also became popular in the 1990s, or that's when they started becoming popular and were considered alternatives. Now, private equity has indeed been around for a while, but they are actually still partially considered part of the alternatives route. But at some point also, again, everybody now is very comfortable and familiar with private equity, hedge funds, and structured products. So now in the 2000s, they are also considered traditional. Which is going to be now the new alternatives asset class? Probably natural resources, which also, again, have been around for a while. However, as now they become more mainstream with the recent fluctuations in the oil and gas market and barrels of oil and how much they cost, everybody shifts their attention to natural resources, the next hot alternatives probably. And of course, on the last note, on the major index inception, that's where you had your various hedge fund indices. We'll talk a little bit more about hedge funds in a few more slides. Now, again, wrapping this up, a conversation on alternatives. Alternatives are just simply asset classes that are not your traditional mainstream asset classes, and this definition constantly changes. Let's now look at, very quickly, the private equity world. Private equity typically starts off with your leveraged buyouts. Your leveraged buyouts are simply using a massive amount of debt to buy a firm out, use the internally generated cash flows to then pay for the debt and the mortgage, the debt as well as the interest. Mortgages. This is where a quick example of what a leveraged buyout would be. Let's say you're about to buy a real estate investment property and the current owners maybe have 80% equity and 20% debt left on the mortgage. You go ahead and you buy this particular property and you put down anywhere between 10 to 20% down and you mortgage the rest. Because you have an extremely high level of debt, this is considered high leverage buyout, so to speak. With this leverage buyout, over time, let's say you use this property as an investment property and you rent it out and you gain rental income. The rental income hopefully more than offsets the mortgage as well as other expenses, such that over time your equity value use the internally generated cash flows to pay down the debt so that you build equity. And that's why that term, build equity, is very important here. So basically the idea is these large private equity firms will come in, employ a significant amount of equity capital, but employ even more debt to buy the entire firm out, hopefully using internally generated cash flows to pay this down. For more information on leveraged buyouts and all the different things that are included in the model, please refer to our module on leveraged buyout overviews. Let us now look at the typical structure of a private equity fund. The private equity fund itself is where all the investments are made. This is the legal entity in which you have a general partner, a GP. This is the typical partnership structure. The GP is the active management. They are the ones who actively manage the private equity fund. The limited partnerships, the LPs, the limited partners, the LPs, they're the ones who simply provide the cash. They provide the capital for the private equity fund and the general partner to now make investments in these portfolio companies. You have a whole set and a whole portfolio of different companies that this private equity fund owns, and therefore over time, again, this fund will eventually liquidate. Usually it's anywhere between a 7 to 10 year time horizon for this private equity fund's life. And the idea is that everybody is trying to use extremely active management now to try to extract additional value. You have a general partner who actually manages the fund, the limited partners who actually put the capital in but do not actively oversee the management of the investments and the portfolio companies. Private equity fund of funds are basically additional vehicles which allow you to diversify access to many private equity funds. These private equity funds invest in these private equity fund of funds invest in other private equity funds as the LP, as one of the many LPs. This again allows instant access and diversification to many private equity funds without having to meet minimum requirements. For instance, the minimum requirement for a private equity fund might be $1 million or even $5 million for you to invest. Well, if you only have $5 million to invest, that means you're isolated to one fund. You can invest that $5 million in a private equity fund who now has, let's say, a portfolio of, let's say, anywhere between a dozen or so other private equity funds. Of course, this is a great instant diversification tool, but you pay for it because the typical fee structure is you pay another percentage point on top of the regular private equity fees.